Hey guys, before we jump into today's episode, I just want to say a couple of things. First and foremost, I know we are living through unprecedented times right now, and there's a lot of fear going around, rightfully so. But one thing I want to make crystal clear is the fact that this show, the We Talk Money show, my YouTube channel, and everything we do at the Skill Incubator is not about selling fear. I've noticed a lot of people in the media that are really twisting that knife of fear and selling narratives of why the financial markets are over and the world is coming to an end and just a lot of doom and gloom scenarios. And one thing I just want to preface this episode with is that you'll notice that the three of us in this show are optimists. We're not blind bulls. We know how to recognize the difference between real risk and danger and irrational fear that leads to panic. And one thing I would just encourage you to do in this time of volatility is take every opinion you hear with a grain of salt, including ours, and form your own opinions. And also know that everything we talk about in this show, we view through our lenses as full-time professional investors. That's what we do. We spend our entire day making investments, managing investments, sometimes taking shorter term trades. We're in public markets, private markets, gold, Bitcoin, right? We are opportunistic. And in times like these, it's important to keep in mind that great fortunes are made and lost sometimes with just one or two what seem like little decisions at the time. So I feel like this is one of, if not our most important episodes so far. And with that said, let's go ahead and jump right into it. All right. Hey guys, welcome back to this decentralized version of We Talk Money. We are practicing social distancing. Today is March 18th. And man, I don't know. Where do we begin, guys?
That's a great question, Chris, because everything is just, everyone's shell shocked right now. Everyone I'm talking to, people that are in the market daily, that are professional investors, contacts of mine are shell shocked, but also people outside, family members, friends, over not only what's going on in the market, obviously, but what's going on in society and things being shut down. It feels surreal almost.
Yeah. Definitely unprecedented times. And why don't we just go ahead and jump into looking at some data and talking about what's happening right now and how people can kind of position themselves to not get crushed. Right? Goal number one in market environments like this is capital preservation and surviving through drawdowns, and positioning yourself, like we talked about in the last show, about how to thrive as we come out of events like this.
Yep.
And what are the possible outcomes, right? So without further ado, let's just jump into it. And I want to start just by looking at this. I thought this was really interesting. And I always like to kind of take I guess we could call it a market sentiment look at what people are thinking and feeling. And usually there's some consensus, but right now, looking at this survey from a few days ago, we had about 1,000 people answer this question, which is, how do you see this playing out for the markets and the economy? The first answer was a recession like 2008 or maybe 2001. About a third of people said that was most likely. Second option was depression, 1929, also a third. And then a V-bottom recovery like 87, just under a third. And then stagflation like the 1970s. I thought there would be more people that would be in this camp, but that was the lowest. So with the new information that we have, I guess I'll kick it to you, Nikki and Trav. What do you guys think? Or do you even have a strong opinion, or is there just too much uncertainty right now?
I definitely think that there's too much uncertainty to a degree, but also I'm kind of taking the approach that I think a depression is a bit extreme of a result that could come from this. I'm kind of thinking more so if we can get a handle on this virus and bend the curve, so to speak, flatten the curve, then I think that we could see a recovery that's quicker than we think. At least that's my take on it.
Yeah, I tend to agree that, as long as these numbers are going exponential, it's going to be really hard to try to find a reason for a bottom. But I don't know, Travis, do you have another take on that?
No, I mean, I think, generally most people right now are looking at what's going on in markets and they're probably thinking, how is this not going to get worse? How is this not going to be the worst thing since the Great Depression? But it's hard to see the sunrise when it's dark out, right? Like it's just, we know that, we know that things are going to be tough. And personally, I'm expecting, a relatively short-lived recession. And I've been pricing my stocks and my financial models based on those assumptions. I think people are going to want to get back out there. They're going to want to contribute to the economy. They're going to want to work. They're going to want to help each other, frankly. And so I think people are forgetting the spirit of that. And so, or at least some people are. I'm actually seeing some things online where people are banding together already, and we've seen the videos of like the Italians singing to each other on their balcony and stuff like that, right?
Yeah.
That's the kind of thing that gives me long-term optimism. There are certain companies that may not make it through this environment, and there's going to be some obviously economic pain for certain sectors and certain people. But I tend to be optimistic, and I think like we're going to get through it. The good news is we know it's kind of a short-term phenomenon as far as shutting down. And then once we come out of that, I think people are going to be eager to really move things forward. And so are we going to be at the same level of economic activity as we were in December of 2019? No, certainly not. And we're going to have to work through some financial implications of all of this. But we've got the federal government, we've got the central banks behind us trying to do what they can to help. And I just believe in, people in general. And so I think, I hope that anybody who thinks a depression is likely doesn't want that to happen, because that would be a scenario where I would be very sad to know if that was coming, because that creates a lot of anguish for a lot of people. And I don't think that's going to be the case here. I think we're in one of the deeper parts of the night, and morning will come. We need to have some faith.
So just, judging on my anecdotal evidence from social media and the news, Trav, I would put you in a kind of the minority right now, right? And that's usually the case in deep recessions. Is it's very hard to find reasons to be optimistic when things, like you said, when you're in the middle of the night. And the question, there are a lot of unknowns. And obviously the biggest thing right now, everything is kind of hinging on the coronavirus cases. And as long as the perception is that this is getting worse and worse and that numbers are going up exponentially, like for example, here in the US, like New York is absolutely getting crushed today. And I expect these numbers to be much, much higher because the US is doing an absolutely terrible job at testing. And you can see just overnight from the day before yesterday, we basically doubled new cases. And so my opinion is, as long as these numbers are going parabolic, that's just going to spur more and more fear. But I tend to want to be in the same camp as you, as a long-term optimist on humanity. I'm bullish on humanity, and I do feel like we'll get through this. The question is I don't think there's a question that this is going to impact the global economy. It already is. I mean, the world is coming to a halt. Nobody that's alive today has seen anything like this. And the only question is how fast can we contain it, and what's the recovery going to look like? Yeah. And I've seen opinions on both sides. I would say probably 80% of people are in the camp that no, things are terrible. And there's a lot of people that are calling for like the end of the dollar. And, there's a lot of, we can talk about the Fed, and Travis, I want to let you kind of take that conversation, but looking at, what the Fed is doing, the bullets they're throwing at this, are they going to work? And is it the right move? And is it the end of the dollar as we know it? And are we going to have a reset? And, is the world coming to an end? Or what is the other possibility there?
Yeah, great question. I'm glad we're talking about this, because I feel like a lot of people need to like take a step back from the ledge. I saw so many comments this past week about, oh, the Fed's now out of bullets. That's it. It's over. It's done. No, the Fed has plenty more things they can do. They haven't even really started buying other assets outside of government bonds, which they could do if they wanted. They can lend directly to businesses if they want. They can monetize a huge portion of the deficit or the debt if they need to, which would enable the US government to do even more fiscal spending measures, right? So there's more that can be done, but what they're doing is actually pretty aggressive right now. We have to remember that we don't see the impact of a lot of monetary and fiscal policy until a couple months later. And so, like if you're judging the reaction of the stock market, in 24 hours after the Fed announces what they're doing, then maybe it doesn't look like what they're doing is effective, but you got to give it some time.
Yeah.
And again, they're doing really aggressive things. There's a lot of scary things happening in the credit markets right now, to be honest. There are probably multiple large hedge funds not only taking down leverage, but maybe even getting liquidated in some cases. So there's a lot of stress on the system. There's a lot of investment firms having to force sell positions and things like that. And it's causing credit spreads to blow out, things like that. So, and also there's demands on banks from businesses and individuals who are trying to get their cash because they need it, right? So we've seen businesses draw on their revolving credit lines. We've seen individuals even lining up at some ATMs in some areas. And so to relieve some of the stress on the credit system, the Fed, as you can see in what you're showing there, has announced a number of measures over the last 3-4 days. This is all very good. Like if the Fed wasn't doing this, you would see a collapse of the system. So the fact that they're supporting credit to households and businesses through the commercial paper funding facility, and the fact that they are, getting involved in making giving capital available to banks and reducing reserve requirements and all of those types of things that they've done in the last week is very good. And I think we'll continue to see them do that. So it's good to have this support. There's more they will continue to do. And I'm not rooting for a complete, collapse of the system, because that will mean pain for everyone in the world. So I want to be optimistic and root for this. And I think if we can get through this really tough period over the next couple of weeks, we'll come out the other side and be okay.
Awesome. I mean, so why don't we do this? Let's just talk about what the Fed has done so far and maybe what bullets they do have left, because I do see a lot of misinformation and fear mongering. And unfortunately, there's a lot of people that I see on YouTube and that have newsletters that just only look at one side. They've made their mind up. We're going down, the dollar's, going to go away or whatever. I mean, I'm seeing the craziest conspiracies.
Yeah. Return to a gold standard. I've seen that mentioned a lot.
Yeah, I mean,
that's not going to happen.
Gold bugs that are shaking that again. Yeah. Why don't we talk about what's happened and then what else they could do?
Yeah. So obviously they're back doing quantitative easing. They've lowered rates to 0% as far as the Fed funds rate. They have, made credit lines available for banks and various businesses as well. They, like I said earlier, they reduce reserve requirements on banks, which helps release some of the constraints on banks for lending. And there's also more they can continue to do. Like I said, we may see a day where they go and they decide to actually, buy corporate bonds or even buy corporate equities or help support, other asset markets. So they can do those types of things to try to inject some stability. There are a whole host of other measures that, to be honest, I'm not even familiar with, because there's a lot of banking sector, I guess you could say mechanics that a lot of us outside the system don't even know about. So I think the Fed will be there to support in every way that they can. It doesn't, solve the virus issue, and it doesn't stop us from having to shut down society to some degree for 2 or 3 weeks to try to flatten the curve. But it does help at least incrementally relieve some stress on businesses and on the credit system. So,
well, Trev, and the common question that I hear and the argument that some people make is, well, what about when the Fed starts doing these airdrops of trillions of dollars? Is that going to devalue the dollar and blow up the economy and make things even worse?
Yeah, it's a good point. So right now, as we're seeing, we're in a deflationary environment. We're seeing the prices of assets deflate. We're seeing the prices of at least some types of services and goods deflate, right? Like you can get a much cheaper airline ticket or a cruise line ticket now, right? So just generally across the environment, if you took a weighted average on everything, looks like, at least in the near term, in a deflationary environment. So that's why you can get such a large amount of, call it dollars or money, put into the economy by the Fed and by the fiscal spending from the government, and not see like a hyperinflationary environment. In 2008, 2009, we saw the same thing. The economy was headed into deflation. And when we saw the high level of monetary and fiscal response, you had a lot of people screaming for hyperinflation over the next couple of years. We didn't get that. And the reason we didn't get that is because people have a misguided understanding of what happens with a lot of this money. A lot of the money that is provided by the Fed actually just replaces credit that's already in the system. So you're substituting, for instance, shorter term bonds for longer term bonds, or, holdings of bonds for, straight cash that's still going to sit there on the balance sheet because there may not be enough lending opportunities for certain banks, right? So this money, when you look at, you have to also look at the velocity of money and how it's moving through the economy. The slug of money itself doesn't necessarily mean we get, massive inflation. It's also how is money flowing through the system. And so, I do think there is a prospect for higher inflation down the line, but we're not there at this point because the economy is actually headed the other way. We're actually deflating. And that may be too why we actually may end up with slightly negative rates, which is another thing people forget. They're like, oh, Fed's at zero, there's nowhere else to go. Well, actually they could go to negative rates. So there's, really no limit.
Yeah. Talking about the deflationary period that we're in right now and assets going down, this seems to be, at least as of today, and I think this chart is at least a day or two old, on the ES, at least on the S&P, we traded as low as, I believe, 33 to 34% down today. So this seems to be much more of an aggressive, faster panic than than 08, or even, the tech .com bubble of 2000. So what do you guys make of that with the speed and the veracity at which we're selling off?
Yeah, I think that, it's the way I'm kind of looking at it is it's similar to when you see a parabolic move higher, like when we saw what we did in Tesla, for example. I mean, when we see these very far, very fast runs, we're going to get volatility with that. I mean, it's inevitable. So there's no surprise that we're seeing the volatility that we're seeing right now. And there's still so much uncertainty on the backside of the move we've already seen. So I do think that with a run that quickly, that fast, that quickly, that the bounce on this or the recovery on this could be just as fast. Obviously, it's hard to say, but that's kind of what I'm anticipating going forward. I don't know. That's kind of how I'm reading the price action and reading what's going on currently.
Yeah, I wouldn't be surprised to see, if we just look at this as one run, like on the weekly chart, and measure from the high to the pivot low. And man, these charts are moving at a snail's pace today because everybody in the world is online right now. I wouldn't be surprised to see, just really, really big volatility, right? And, like an aggressive bottom at some point and then maybe another leg down. And I think the key is, facing uncertainty and not knowing how bad or how long the virus issue is going to last. I think the main way that people can manage risk in these environments is, if you have cash is king right now. And if you do, how do you get into the market? How do you buy the blood, right? Because I'm usually a huge fan of buying blood, but with this level of uncertainty, I'm a little more conservative. So I've been looking at, potentials on the downside, looking at percentage runs, right? Like, so right now we're down by a third. Well, what would happen if we went to a half? And then kind of using the Kelly formula in a way to try to size in based on how bad things could get. What do you guys think?
Yeah, I think that's a smart way to think about it. I've been accumulating individual stocks that are already down 50 to 75%. So it's sort of like they've already hit some of those levels. but in terms of the broad market, I've been saying for the past, I think, week or two that I think we could see 2K on the S&P, and that was just based on some bottoms up forecast, looking at how deep I thought earnings were going to be down for the year for the S&P 500 companies, and then applying kind of a slightly below average multiple since there is so much uncertainty and fear. And that gets you to about a 2K on the S&P, kind of in a kind of a darker case scenario, not worst case, but what I think is probably a more likely scenario for the near term. But again, I think the recovery can be relatively quick because we have seen such a sharp sell-off in this event that we know, like we do know that the world is going to look a lot different a month from now, assuming we flatten the curves and do all the right things.
I think that's a good time to pull this chart up, Trav. Do you want to explain what this is?
Yeah, so this is a chart showing the new cases in China in various cities. And so you can see that obviously this got really ugly at late January, early February. You can see that in like the red and the brown numbers where new cases were really, really bad. And Hubei was obviously the place where it originated and had the worst problem with it. But you can see as we approach, after about a month even in that province, new cases started to fall off and that curve flattened. And now, in mid-March, they actually looks like they potentially have this thing relatively well contained, knock on wood. So this, I've heard some people today talk about, well, we could be in shutdowns and quarantines for 18 months. I think that's a way over exaggeration. I think when the government was talking about 18 months, they were saying, we could be dealing with some of the after effects and some of the secondary spikes next winter, but hopefully by then we'll have vaccines and we'll know how to deal with it better. I think in the immediate term, we're hopefully going to be able to bend this curve. Cases are going to go up a lot in the US for the next couple of days and weeks. But hopefully by, I would say, mid-April, we'll see something similar to what we saw in that China chart, where a lot of the problems, that curve flattens and new cases actually decline. So then I think we get optimism again.
Yeah. And, even if you don't believe the numbers out of China, which I tend not to, call me skeptical, but I do trust the numbers out of South Korea more. And even looking at this, I think South Korea is probably the model for how this should be handled. I mean, they've on a net basis and population per million, like they've absolutely dominated the US. And as far as how many tests they've put out, while in the US, for some reason, we are prioritizing fucking celebrities over people that are actually sick and have been in contact with people with the virus. But I'm not going to go off on a tangent on that about how bad the U.S. has mismanaged this. But if we look at the good examples around the world, you can see what can happen. And I tend to agree with you. As soon as we start to see something like this, where the new cases start to fall off, like daily new cases in South Korea, and they even had an issue where it was, I think, called patient 31 or something like that, where, one person got out and spread it to at least a few hundred, which, that can spiral out of control. And that's why people really need to take this whole social distancing thing seriously. For example, in the city that we're in here in Texas, we had a friend of ours that tested positive. And before he knew he was positive, he actually went to an event where there were about 200 other entrepreneurs at this event, and now he's exposed them. So no, the point being is these numbers can spiral out of control quickly, and the faster you cap it, the more aggressive a country is, the better it is in the long term. And so I wish the US hadn't slow played this and called it a hoax and, basically downplayed the seriousness of it for so long. But now I feel like the past couple of days has been kind of a turning point for that. And hopefully we do start to see the flattening of the curve.
Yeah, it has been encouraging to see that finally the authorities and different cities and states and organizations at higher levels have finally started to take it seriously. And so I think now that gives me encouragement going forward. Yeah. But it did take too damn long. It should have been done a month and a half ago when we saw the problem emerging in China. So
absolutely.
I guess we'll learn from it.
Hopefully, talk about some sentiment and forward readings, and just, I guess, to maybe give people a little bit of context around what it's due over time.
Yeah, I guess I'm the guy today that's all about optimism, because
you are a rare breed, my friend.
I know, But, you know, I've talked about this in my stock investing courses before. This chart here shows that, you know, when we look at a little bit longer term time frames, right? So not looking at what's going to happen tomorrow or this week or how much we're going to bounce, you know, 3 weeks from now. But if we look at the returns of, you know, broad equity indexes over like 6 months or a year, we can see that typically when we are in an environment like we are now, where the sentiment is extreme fear, where most people have a, you know, a really gloomy outlook about the next 12 months, it's actually when the market tends to have really good long-term returns. So like, again, when we're in like the bottom 5% of extreme fear readings, you can see from this chart, the S&P actually has pretty good average 1-year returns after that. It's kind of counterintuitive, right? Because it's like when everyone is at the max point of pessimism and fear is actually tends to be when the market gets pretty cheap. And then so you can have good returns, assuming you're taking a more longer term perspective. So, and the opposite is true, of course, extreme greed, which we were probably at in like late December 2019 or, you know, January 2020, when we saw those like parabolic spikes and Wall Street bets was making the news, right?
Yeah.
That was an extreme greed reading, and it, you know, aligns up with what we're seeing, which is returns were bad after that. So
yeah, I mean, and the same is true with Bitcoin, right? It's like when prices are in the gutter and everybody gives up, that's the time to buy. And when everybody's freaking out and mortgaging their house to buy at the all-time highs, that's the time to sell.
Yeah. Yeah. So I'm not saying, you know, now's the exact moment where, you know, it's the market's going to bottom, but I do think the probability and statistics shows us that we're likely on a longer term basis to see this as a pretty good entry point.
Mm-hmm. Awesome. So this is, I think, just an expanded chart of what you're talking about. So looking at, you know,
specific days.
Yeah.
Where the specific dates that in history, you can see some of those dates or examples like in, you know, September 08, where, you know, or, you know, other time periods, like, you know, right after 9/11 attacks and stuff. These are dates where the market had reached a point where the, you know, fear and sentiment was really bad, or sentiment was bad and fear was really high. And then when you look out at the longer term returns from that date, most of them tend to be pretty good.
Yeah. Awesome.
This is a good reminder that, you know, we have seen these types of bear markets before, and we've seen these types of sell-offs and panics in history. And
yeah, this one's definitely unique,
but for sure.
That's the question. And I hear people thumping this is, you know, this time is different, right? Like,
yeah.
Why could they be right and why could they be wrong? You know, I feel like on this show, we like to look at both sides pragmatically, but you know, when people say like this time is different, well, I would say like every time is different, right? Like every recession, every panic, it's different circumstances.
Yep.
But one thing that doesn't really change is human reaction to both good and bad events.
Yeah. I agree 100% with that.
Mm-hmm.
So taking a look at where we are today. So we've got Bitcoin basically hanging on here on the weekly chart to the 200 period moving average. Usually I'm a fan of anytime there's massive blood, just buying heavily into that. That's served me well over the past 7 or 8 years in Bitcoin. With that said, this for me is kind of, I found myself questioning just the timing on this, right?
Mm-hmm.
Like, even though prices are down basically by half on the year from the highs of the year around 10K. And, you know, the other day we made a low of 4K hanging out around 5 to 5,500 today. Like, this to me doesn't have to be the bottom. So one thing that I've looked at over the past week is just my overall portfolio, and have looked at the fact that I have about 35% cash, right? Everything else is diversified between stocks, bonds, crypto, gold, metals, you know, startup investing, basically all the dozen or more asset classes that I had in my my previous video where I talked about kind of my machine and how I invest in different areas. But I feel very good about the fact that I have like a third of my overall net worth is cash right now. When markets start to come down, instead of just trying to pick the bottom, what I like to do is scale in. So like buy some and then say, well, what if the market keeps falling, and then try to build into a position. You know, to me, that's different than like adding to a loser, right? It's like building in as you get better and better prices. How do you guys tend to think about that?
Yeah, I think that approach, I mean, that's the same approach that I'm using right now in the stock market, which, I've been trying to be patient, and I've had to fight myself a little bit because I do tend to read into the charts and the price action. And, but at the same time, I've had to step back and say, obviously I'm seeing value that I want to hold long term. So it's that I think that is the best approach when you have so much unknown, in front of you. That way you're benefiting if this is the bottom, right? You have some skin in the game. But if it's not the bottom and you have that long-term vision, then you could have the potential to really average in at a really good price for holding it long term. So I think that's probably, the best approach. It doesn't have to be all or nothing, right? That's where people can kind of get in trouble, is when they sit on their hands and they don't do anything because they're like, oh, we're going to see whatever they're thinking, 50% in the stock market or 1,000 Bitcoin or whatever it is people think. They could have that approach and be waiting for it, and then it never comes, right? And then stuff takes off on them and reverses, and they never get their chance, and they never get in. So I don't know. I think scaling in is the better approach here.
Yeah. I saw somebody on Twitter today say, I called my financial advisor and told him to put me in all cash. And
he's probably already down 40 or 50%, and now he's selling everything.
Yeah. And look, I'll never troll anybody over their decisions, because to each our own, right? Instead of trolling, the better thing is just take the opposite side of the trade, right?
Mm-hmm.
But I can't help but stop and think, because we've been here before, right? Like all three of us lived through 2008. We were just getting into the game during the .com bust. It's just interesting to see, even though the data doesn't back up that that's a smart thing to do, that people will still do that, right? They'll let their emotion and their this time is different attitude override what the data says.
Well, when things are bleeding in front of you and you're looking at your accounts and you see drawdowns, it's our natural instinct to feel something, right?
Mm-hmm.
I mean, we're naturally gonna start to see things in the negative and get emotional about it. And it's not that that's wrong, because we are humans. We are going to feel something. But with investing, you really have to remember why you're investing, for one. And you have to remember that, you have to think about it in a more pragmatic approach, because the market is just, there are so many emotions. That's literally what price action is. It's showing us the emotions in the market. And obviously, when you're just seeing selling after selling after selling, no matter how much you think you're prepared for it, it can catch you off guard and kind of paralyze you in the moment. So it's just really important to take that step back, take a breath before you make any rash decisions, and ask yourself a few questions, and I have a few questions that I like to ask myself. And it's, is this an opportunity for me to own something that I thought I missed the boat on prior, that, I can have and hold long term? Also, do you believe that we can recover from this? Do you think that we're eventually going to make it out of this? Or do you think this is it and everything's going to go to zero? Hopefully, like we've explained today, I do believe in humanity. I do believe that we will figure this out. We'll come out of it eventually. But if you don't kind of take that step back and think pragmatically about it, you are going to hit that panic sell button. Mm-hmm. And you could end up regretting that decision immensely. That person that you talked about that wants to go all cash, that could end up being something they look back on in a few years and just have their palm in their hand. Like, what did I do?
Yeah. I mean, I've seen that in Bitcoin, at the end of 2014, when Bitcoin dipped back below $200. I mean, I got several emails like, I can't take the pain anymore. And they were literally on the day that they were selling into my buy orders. Right. So it's very interesting how that happens. And granted, like I don't always pick lows or tops. Like that's not the goal, but it's those moments of extreme capitulation that are usually pivot points in markets, but also like you said, I mean, those are usually the max point of pain that turns into regret later.
Exactly.
So even though we don't know what's going to happen, I mean, we might look forward 3, 6, 12 months out and go, wow, the market had a lot more down to go. But like we saw with Travis's hedge fund in '08, they set themselves up for their biggest year ever coming out of that recession. So the only way that I really see that people lose in this is if they do something that takes them out of the game, right? If they do something dumb, like they overtrade with leverage or they get under diversified, a lot of the stuff we talked about last week. But I think focusing on those core concepts is really important. And so, you know, I was a little bit just kind of flustered with the amount of information I was taking in yesterday. So I just wanted to put some thoughts down on Twitter. And I just kind of rattled off 11 random thoughts for traders during these unprecedented times. So maybe we can just expand on a couple of these. And if you guys have anything else that you want to add to this, I think maybe this would be a good time just to add some context to what people could do and what are the things they should absolutely like stay away from. And talking about crypto specifically, I think one of the biggest things is like, guys, stop trading on shitty, unregulated exchanges with margin. Like, I don't know how many examples we have to see of people getting blown up, completely liquidated. You know, and it's survivalship bias, because every now and then you'll get some idiot on Twitter that talks about these insane gains they're getting on BitMEX or something. But it's survivorship bias, because 99% of people that are on there blow up, period. It's the same thing that we talked about with Wall Street bets. And, you know, kind of hand in hand with that. And I know a lot of people don't want to hear this. Somebody's sitting there going, shut up, Chris. Like, but it's reality. I'm not here to tell you what you want to hear. I'm here to give you the truth. And the data also shows that almost all day traders lose money over time. And the ones that do make money don't really make that much money, right? And over trading, in my experience, is the number one reason that people lose is they just get too excited. They take too many trades, and it's either death by 1,000 cuts or they get over leveraged and they blow up. What do you guys think? Is that on point, or am I missing something?
On point. I think that's on point, especially the over trading especially in a market that's this volatile. It can be great if you know what you're doing, but if you don't know what you're doing, you can get chopped out so easily.
Yeah. This is a time when emotions are running high. And not only that, like I said, you've got forced liquidations happening. So prices are doing really silly things that don't make logical sense in some cases. And so it messes with your logical brain, and it kind of forces a lot of people, or doesn't force, but it encourages a lot of people to make really rash decisions. Whether that's like, you know, taking permanent losses on positions that, you know, they should have held on to, or it's trying to like make up for their drawdown by getting into like, you know, some swing trade that they wouldn't have otherwise, you know, trying to make a bigger bet, like almost like a martingale strategy where you double down on the next trade or something like that to try to make up for it.
Yeah.
And that's the kind of stuff that you know, you got to try to avoid if you can. Like, it's hard trying to regulate your emotions in weeks like this. It's been tough for me this week too, even though I feel like I've been through it before, like in '08. So it's just tough, but you gotta try to keep working on it, and trade journaling, stuff that Nikki's talked about in the past, helps. You know, taking walks, getting outside, getting away from the computer, not watching prices every tick, every second. And then just being comfortable with what you know, if you're not over levered and you're buying companies that, you know, don't have high bankruptcy risk in the short term, then just be comfortable. You know, you probably didn't pick the exact bottom in a market like this, but be comfortable with what you own, and just have some faith that, you know, 3 years from now, 5 years from now, 10 years from now, your wealth will have grown in those positions, most likely.
Yeah. And to that point, kind of the last thing I said here was buying during market downturns feels really weird, right? It doesn't feel good. It's like, it's a strange feeling, but the data does show, like we just talked about, that the biggest returns come when market sentiment is at multi-year lows. And Nikki, I heard you starting to say something.
Oh, yeah. I was just going to say, you know, one thing for me personally in my investing, something that's just helped me dramatically is understanding fundamental analysis with stocks. Because, Travis and I have talked about this before, and as I've been accumulating positions over the past, few years or whatever, I've been accumulating positions that I feel good about fundamentally that can make it, and that's I think what gives me some peace of mind is understanding that, hey, I do know what this company's balance sheet looks like, and I do know that they can make it through, a recession. So I think that it's really important, if you are feeling just unsure about your portfolio, or you're just feeling a little just unsecure about everything, that can be a very great technique to learn, is fundamental analysis. And, even being able to do things like Travis has said, some napkin math to get a feel for how much earnings can decrease and get us some levels that we might see in the market. It's just helped me a lot kind of process all of this and not be so afraid, or so I don't feel scared of a sell-off even deeper from here. I feel prepared for it, if that makes sense.
So that, I feel like that's a really good point. Do you guys have an example of a stock or two that has strong fundamentals that we can use as kind of a case study for that, right? Because I think the idea was, okay, even if the global economy shuts down for 1, 2, 3 quarters, what are the companies that could survive, right? Because not every company is just going to die, right? Like, humanity is not ending. Like, it's going to be ugly in the short term, but when we come out of this, like, companies are going to survive. And if you can buy them at a discount now and you pick the ones that do survive, you're going to make a lot of money. So do you guys have an example? And if so, what are the key kind of fundamental metrics, or the most important ones that you look at?
Well, Chris, you literally had one up on your screen a minute ago, which is Twitter. Twitter's got $4 billion of net cash on their balance sheet. So, this is a stock that's sold off a lot. Their user growth has been accelerating over the last 4 quarters. Their business metrics are generally trending in the right direction, with the exception of maybe on the expense side. They've let expenses run a little bit hot, which has actually hurt their profit margins in 2019. But overall, it's a company that's still growing the user base nicely, probably seeing increased engagement in this current environment.
Oh, yeah.
And, the stock's down, almost 50% from where it was in the fall. So yeah, it will survive any kind of tough environment over the next 2 years because it's got so much cash on the balance sheet. And
so you look at how much
valuation,
cash they have and how much debt they have, and basically look at, okay, if we go into an extended bear market in a really bad scenario, who could survive because they have cash?
Yeah, that's a big one. That's first and foremost in an environment like this, is just making sure they have the liquidity to actually make it through.
Yeah.
And then beyond that, then it comes down to like, well, what are you paying as valuation wise? What currently is the company generating in cash flows and earnings? And what might it be able to do 2 years, 3 years, 5 years from now? The way that stocks are valued is based on a sum of the future cash flows, essentially, or a sum of the discounted future cash flows. So the value of a company depends on the value of its cash flows, for years and years and years, 10, 20, 30 years. So one blip in, a decline in year one certainly does hit the total value, but it shouldn't change the total value by, 75% on a company like this. Because it's going to be generating increasing amounts of cash flows 5, 10, 15 years from now. So yeah, I like to look at, well, what do I think they can generate in free cash flows a couple of years from now? What's the multiple of that with the current market cap? In Twitter's case, I think they can be producing well over $1 billion of free cash flow in a couple of years. They have several activist investors who just joined the board at the company to help, the company push towards more efficiency and greater innovation speed. So there's a lot of positive things happening here. And today, you're paying, I want to say, an enterprise value of about $13 billion for Twitter. And again, I think it can generate over $1 billion of free cash flows in a couple of years. So that's a very low multiple for a very safe company that is growing. Typically, we'd see like a 20 or 25 multiple of free cash flow on a company like this. Mm-hmm. But obviously, in this environment, the stock is being priced for a much more dire scenario. So that's the kind of thing. And some of the metrics I'd look at, there are other metrics too we can look at, but those are probably the good ones, back of the envelope type math stuff.
Nice. Now, let's talk a little bit about crypto. We've talked about this a lot in our community over the past 2 years, really since the insane bubble of 2017 that just got out of hand. You know, my thesis has been and will always be that well over 90% of these cryptos are going to go to zero. And, excuse me. And the reason for that is competition and scams, right? Like most of these are zombie coins anyway. There's still a lot of cryptos that have multi-million, some above 10, 20, $50 million valuations that are basically dead. They really have no real development going on. So in my opinion, we need a culling. We need a mass death in the crypto space that will basically make it healthier as we go forward, right? If you can get rid of the bullshit, then the cream rises to the top. And one thing that we can talk a little bit about is Bitcoin specifically, right? Which is obviously my heaviest crypto position. And, you know, there are some down here in the top 10 to 20 that I think are, you know, have a great potential of surviving over the long term. But whenever we talk about the differences between fundamentals of stocks and crypto, the main difference is stocks, at least the good ones, make money, right? And some of these other cryptos are speculative stores of value, right? Like, can this hold up through a recession? And this, in my opinion, is really Bitcoin's big day. Like, Bitcoin was born in the ashes of the Great Recession. It didn't go through it. It was born because of it. Now is its true test, in my opinion. Like, if it can survive this and if it can maintain its value, and if maybe it even becomes some kind of flight to safety for some people around the world, like, that is really the big test, I think, right now.
That's a really good point. Very interesting.
Yeah. So we'll see. But again, I just would encourage people, like, if you're still looking at the crypto space as something to use the shotgun approach to get rich quick, like, I think you're going to dramatically underperform diversifying and owning equities, right? Again, this isn't financial advice. And eventually, you have to decide where you want to put your capital. But a lot of people that I saw put money into a lot of these projects, they didn't do any research to figure out what the project even was. And if they did, they just bought the story without even really doing due diligence. And that's why so many of these are down 70, 80, 90%. And a lot of them won't come back. Some of them will, right? The ones that have real development and have actual capital and runway could survive. But, as of the time of this recording, there's over 5,000 cryptos listed. I'm saying over 4,000 of those at least are going to go to zero. So just keep that in mind. If you're somebody that's interested in the crypto space, just know that that is a very, very real possibility. And that's something that I do have a lot of conviction about. Obviously, timing is hard, but with a market reaction and a global scare like this, I think this could be the event that's going to naturally just cull and clean a lot of the dead weight out of the crypto space. So
Yep.
It's probably not what a lot of people want to hear. And look, I'm a crypto fan. I went all in quite literally with my time and my capital in 2013. So I'm here for life. I'm a Bitcoiner first and foremost. I do like some other projects, but I also recognize the risks in this space. And that's why I'm also a big fan of the stock market, even though it's easy to hate on the stock market and it's easy to look at the Fed and point out the problems, and the way that the system works is not ideal. But I don't know. I'm not a hardcore, anti-Fed guy either.
So one thing that I think is helpful for some people to think about is because when we talk about the stock market, it almost seems abstract. But if you think about it as in like, do you want to own businesses? Would you be willing to put your capital into highly cash generating businesses?
Yeah.
And most people would probably say yes. Like,
yeah,
especially if you frame it in a way like, find the, the highest volume Chick-fil-A or Starbucks in their town, right? And would you want to own that? Would you want to be an owner and have the cash flows flowing to you? Hell yeah. Most people would, right?
Yeah.
Would you want to be like, Mark Zuckerberg and own, a big chunk of Facebook? Of course you would, right? Like,
yeah.
so that's
$70 billion worth of ads a year, right? Like
Exactly. Yeah. Right. So I like to think, I like to help people frame, what stocks are in that way. It's like, if they were private businesses that you were looking to buy stakes in, you wouldn't have such a negative attitude about it probably. And you'd realize that there's inherent value in it, no matter what the Fed is doing or not. Like, imagine a world where the Fed doesn't exist. Even if you want to imagine a world with a gold standard, we still had a stock market because, businesses drive the economy, and businesses are fantastic assets in many cases. So the stock market's not going to go away. No matter how bad this gets, the stock market's still going to be around. There's going to be great companies. You'll want to own some of them, especially when they're trading at 30 to 50% cheaper prices than they were a month ago.
Yeah.
That's kind of what I try to tell people. But, not everybody's, it's not for everyone, which is totally fine.
Yeah.
Well, I mean, look at what's happening with our companies shutting down, right? Like, I mean, the world is literally shutting down.
Yeah.
Corporations are important. They provide jobs. They make everything kind of work. And I think this situation we're in is a bit of proof of that we need corporations and businesses that make money and cash flow and can, help the economy move along.
Yeah.
Absolutely. Yeah. You guys want to talk about metals quickly?
Definitely.
So one thing that's pretty interesting, and I just pulled up a website where this is just one of many websites where you can buy gold with Bitcoin. You can see the note here. Due to extreme order volumes, please expect shipping delays. So
wow.
Basically, and I talked to a couple of people this week that went to buy physical metals in their local towns. A lot of shops are completely sold out.
Yep.
So pretty interesting dynamic where you've got the price of spot gold that's falling, but supply is getting sucked up. What do you guys make of that?
That is really interesting.
Super interesting. Yeah. You're seeing a run on physical metal. And then the paper versions, the ETFs like SLV and GLD have been selling off. Yeah. So there's the spread has widened between the price of physical and the price of, paper or financial holdings of gold. So, and gold and other metals, which I think is really fascinating when these arbitrages happen. I think it bodes well actually for even like GLD and some of the, financial gold holding, because the demand is there. And especially with the monetary response that we're getting to try to help the economy. Like I said, I think once we start to come out on the back half of that, then some of these, inflation, some of these assets that are seen as inflation protection, like gold or Bitcoin, could do very, very well. Yeah. So,
and here's the chart of 08, right? We talked about this last week, how gold actually fell 35% in 08, but then went on to crush over the next few years.
Yeah. So yeah, I think I'm generally pretty constructive on it. I don't know where it's going to go in the next 3 weeks or 6 weeks, but I think it's an interesting holding. Like I do. I think it'd be an interesting part of a broader portfolio.
Yeah.
Sure.
Yeah.
I would rather be in gold than US dollars, right? So like I look at gold, not really as an investment per se, but as a liquid asset that retains its purchasing power over time, right? Yeah. Like the dollar is constantly being devalued over time. There's no question about that. Yeah. Where if you want to stay liquid in some way, your options are cash or cash equivalents or metal, right? So like, or now Bitcoin, right? So Bitcoin is still higher risk, but it also has a really nice risk to reward profile with the stock to flow ratio and a lot of the things we talked about in prior episodes. But I don't know, I'm a fan of gold. I'm a fan of Bitcoin. And like we talked about, timing is hard, and gold has kind of felt like a crowded trade lately. Yeah. So I wouldn't be surprised if we get like a big shakeout. We've seen obviously some liquidations the past couple of weeks, but I like it and I want to have it as a part of my portfolio as well.
And it gives you some protection against that. One of those possibilities that you mentioned before, when we talk about possibilities and probabilities, the stagflation scenario, it's a fantastic asset to own for that type of scenario if you believe that that's likely to happen. Yeah. And so that's really nice property. I will say, I don't think I've seen some pretty crazy scenarios thrown out by some people who think the system is going to collapse and everyone's going to go back to bartering or, trading with gold.
Yeah.
I don't think that's actually very realistic. I don't know what the upside, what the highest upside target that gold might reach in the next couple of years, but I'm pretty confident we're not going to see a return to like a gold standard, at least in the near term.
Yeah.
And that's because the reason I think that's unlikely is because imagine the environment we're in now and what it would look like if we were on a gold standard. We'd have no ability to actually conduct the types of monetary policy and fiscal deficits that we're doing to try to help keep the economy out of a deflationary spiral. And so if we were on a gold standard, we would have very limited capability to deal with that. And what we would be seeing is almost certainly a spiraling into a depression type event where, half the businesses go out of business. Many people are laid off, unemployment rates at Great Depression type levels. And some people want that. They think the system needs a total resetting. I just don't think they really understand how drastic and how much pain that would create for many, many years, and how unstable a system based on a gold standard would be for the foreseeable future. So that's just kind of my personal, I think we could probably argue about it, but I encourage people to think about that. Like if that's what you're talking about happening, think about what that really means and what a world would look like in that scenario. It wouldn't be good.
Yeah. Yeah. And there's a lot of, when emotions are flying high and markets pull back. I mean, we saw this kind of same knee-jerk reaction in 08 and 09 where people were like, oh, here comes hyperinflation. Here comes this and that. And most, if not all of those things failed to materialize. And then the narrative becomes, well, we're just kicking the can further down the road. What do you say to that opinion?
Yeah. I mean, I think in some sense, our system has problems. We have to acknowledge that, with what we're seeing right now, obviously it's clear now that there are certain businesses that should have more excess capital on their balance sheets. I mean, of course, no one saw a situation where the economy gets shut down for a month. But the fact that a lot of companies aren't able to deal with that is certainly a problem, right? And that means we need probably more cash on certain companies' balance sheets. We need more, larger safety nets for that kind of thing. And a host of other things, right? Like maybe some of the credit derivative structures that we have should be rethought, right? Maybe our bank capital ratios, which were raised post the financial crisis, should actually be even higher, right? So maybe some of the lending that happens outside of the banking system from hedge funds and other shadow banking should be looked at with more with a sharper eye, right? So there's definitely things we need to improve. Like this economy is not perfect. Mm-hmm. We can't socialize losses, right? Like that's just not every time large industries face, a precipice of disaster, we can't be bailing out every single industry, right? So I agree with a lot of people.
We can talk about that, looking at what's happened with the airlines and talks of, a bailout for airlines and people being pissed about that because of the share buybacks. What do you make of that?
Yeah, no, I mean, I think, listen, I tweeted some stuff about it this week and I totally understand the perspective. And I think there's a lot there that makes sense. Like, the airlines were buying back their stock because their stocks were trading for 7 times earnings. That looks really cheap. And when you buy back stock, you can actually juice returns for your shareholders, assuming you're in a stable environment. And the fact was, airlines, it looked like they were in a stable environment, right? They kept seeing higher and higher load factors. Planes were more and more full. Their fares had never been higher. So the businesses were booming. The valuations were still pretty low. I can understand why the companies were buying back stock. I mean, a stock buyback is just a dividend by another name. Stock buybacks and dividends are the two ways that companies actually return capital to their shareholders. And companies have to be able to do that because otherwise, stockholders don't invest in companies because there's no way to, get their return on their money, right? So those things have to be able to happen. What you don't want is excessive debt-fueled buybacks. And with the airlines, the unfortunate thing is they had not ever modeled a scenario where there was no global air travel for a month. So that didn't even enter into their planning. And because of that, they hadn't built enough cash on their balance sheet to deal with it. And so now the question is, well, does society bear that cost? Because they are a critical infrastructure provider, right? There's all of the businesses and people at airports and restaurants and hotels and in travel that depend on airlines functioning. And so the question now is, do we let them spiral into a bankruptcy process, the entire industry? What kind of chaos and job losses does that cause? Or do we extend them a bailout? And I think we need to also be a little bit clear about what a bailout means. In this case, I don't think it actually has to be that bad. Like, the airlines need a bridge loan that will cover their cash flow burn for the next 1 to 3 months. And I was doing some back of the envelope math. And from what I calculated, that number for the US airline industry looks like it needs to be about $40 to $50 billion total for the industry. So a $40 to $50 billion loan. Now that loan can get paid back. So the government can loan them that money in the short run. And then over the next 2 to 3 years, as the airlines get back to doing business and throwing cash flow off from the business, they can pay those loans down with some interest. And so especially with government bond yields, at 1 or 2% for long-term bonds, the government's funding cost is low. They can borrow at 1 or 2%, go out and lend to these airlines in a rescue loan at, let's say, 4 or 5%, earn that spread. So they can actually make money on these rescue loans. It's not like they're going to give the airlines money and never get it back. So from a taxpayer perspective, I'm okay if they can give this bridge loan to airlines to keep them out of bankruptcy, keep the system running, get paid an actual return on this bailout loan or rescue loan, as I like to call it, then it's a win-win for everybody. So I don't think you have to be against this. I think it can actually work out. Now, I do think longer term, we need to now ensure that airlines have more cash on their balance sheets more permanently. So I think we can deal with this scenario appropriately without hysterics, I guess, at the end of the day.
But hysterics are so fun. And everybody loves to panic and complain. And, I feel like trying to be the voice of reason at a time like this is not only unpopular, but it can be, very controversial. And as investors, our goal is not to tell people what they want to hear. It's to offer both sides of the coin and let people decide. Right.
Yeah.
Nikki, you did a great post in our Discord community this morning, just talking about the mental side of the markets and how we're approaching this.
That post was awesome, by the way, Nikki. I love that.
Thank you. Thank you.
Yeah, absolutely. Do you want to just give anybody that's listening or watching this show a little bit of perspective, because as the mental coach for our community, I feel like you've got a really good perspective because you talk to traders and investors from all backgrounds, all around the world with different levels of experience and different problems, right? And so at a time like this, I think people just need to be reassured of some things or maybe learn some hard lessons that might have cost them some money and, chalk it up to experience, which we've all been there. But what advice would you give to somebody who's maybe newer to investing or trading and hasn't been through a recession or a really scary time like this before?
Yeah. So, a lot of financial advisors and financial planners and et cetera, they try to prepare their clients for this. And as what I try to do in the community and what I think Travis does as well is I try to always have people look at all possibilities and probabilities. And it's easier said than done to say when you're in a raging 10-year bull market, if the market, pulls back and we see a bear market, I'll do this, this, and this, right? We think we've got it under control and we'll know how to handle it. But then it faces you and it's happening. And honestly, sometimes it can be as simple as asking yourself the most obvious questions over and over again. So asking yourself something like, okay, am I investing regularly? For one, a lot of people invest regularly into their accounts via their paychecks or IRA contributions or whatever they're doing. And you have to realize that you can benefit in these times when you're doing that. It doesn't all have to be a doom and gloom negative thing. Remember your time frame. Remember why you're investing in the first place. Because a lot of people, they go into positions saying they're going to be long term, and then something like this happens, they freak out, they pull their money out, and then later they slap themselves, in the head, and they're like, "Why did I do that?"
Yep.
I said I was going to be long-term. Why did I change my plan? Why did I get out of the market? And that's what you want to try to avoid. So I just encourage people to take a step back, remember why you're investing, remember remember how long term you are trying to be in your portfolio. You know, are you investing for retirement? Are you trying to save for a goal later? If you're more short term and you're freaking out because you are a short term trader, or you didn't really plan things out well enough, this is that time to really take that as a lesson, and going forward, always have a plan. Always have a plan. That's just the best. Sometimes it's just so simple, and I have to ask people when they say, I don't know what to do. Do I get out of this trade? Do I cut my loss? What do I do? I think I'm going to just, get out. And I just try to tell people, okay, what would you have regrets if, the market reversed, or if the market sold off more? Like, play out every single possibility and probability that could happen on both sides, and imagine how that makes you feel in every single scenario.
Mm-hmm.
And it seems kind of simple, but when you play these scenarios out, it helps you think, okay, no, I do think this is the best thing that I should do. And it helps you get to a conclusion, essentially, by playing all of those different scenarios out.
So that way, and what I kind of wrote on the chart here for people that are watching the video is trade and invest in a way that would leave you with no regrets, regardless of the outcome, right? Because we're dealing with an uncertain future, right? We can come up with a thesis about what's going to happen, but if you're just, like we talked about last week, placing it all on red or doing a coin flip, you might be right? Or you might be wrong. But if you can manage around all the possible scenarios, including black swan events like we just saw, that's going to keep you in the game and then help you to thrive over time. Survival first and then thrive.
Yeah, exactly.
I love the part about like the time frame and mentioning, like, if you're really a long-term investor, a lot of this is just going to look like a regular pullback on the chart over time, like you said. And if you're going to, if you get shaken out and you're like, oh, I'm just going to sell now that it's down already down 30-40%. And then and then the market starts rallying and you got to buy it back higher. A lot of people won't do that. And then at the end of the day, they'll just have this massive frustration and regret at their own self because, they did the emotional thing. They didn't stick it out as a long-term investor. Like,
yeah,
we deal with big drawdowns as long-term investors. It happens.
Yeah, for sure. And I think that it's, like I said, it's easier said than done for some people. But if you just remember that these things happen, and you look historically at the charts and say, okay, yes, we've seen these types of drawdowns before. We've seen bear markets before. Everyone kind of had a feeling that this was coming. But everything feels so good in a bull run, and you almost kind of forget that bears do happen.
Yeah.
Bear markets do happen. And black
swan events happen that are unpredictable, right? And sometimes they correlate with other crazy things like the oil war, which just compounds the negative effects.
And that's the other thing too. This has been a very strange situation with all of this compounding. Not only were we already overheated in a epic bull run, right? We were kind of, I don't know, some people say we were late cycle. Some people say we still had some time. We had the oil shenanigans that happened recently. And then we have coronavirus. It was just compounding events over time. I'm actually surprised the market's not down more, actually, if I'm being honest. But yeah.
Well, there might be more on the way.
One thing that's interesting to note here too, is that, and by the way, oil took another just absolute total dump today, down by 15% and just at low 20s levels. I didn't think we were going to see again, but here we are. But in the bond market is interesting because what's happening there suggests something interesting. Like the 10-year and the 30-year, especially the 30-year, rallied massively in the last 5 days.
I'm playing catch up with these charts. So oil just finally loaded. You can see we're basically at multi-decade lows challenging the lows from like 2001.
Yeah. It's
And this,
really mind blowing.
yeah, this was like a 20-year range of between 10 and $30. So catching up with what you said about bonds, Trav. So right now, really weird stuff going on there. I'll pull up the chart and we can just take a look at what's happening with, obviously a ton of volatility, but what do you make of this where we are right now?
Yeah, it's really interesting. So I think when it became clear that the U.S. was going to do a fiscal stimulus that involved sending checks to people, which is essentially like our little test of basic income, I guess. Hats off to people like Andrew Yang have been pushing that. We're going to get a test of it, at least at a small scale. But the 30-year bond yield, which was I believe at about 1% a couple of days ago.
Yep.
It actually broke below 1% there for a couple of days in, I think around March 9th.
Yep.
It's now doubled. The bond yield has doubled in the past week. So it's pretty unbelievable. And that's now reflecting an expectation of higher long-term interest rates. So that's suggesting that we will move ultimately out of this deflationary environment, that that there is light at the end of the tunnel. So I actually take that as a good sign. And it's interesting too how fast that rally happened. So it also tells me that it sort of confirms what I was saying when yields were below 1% on the 30-year, that you didn't want to be in bonds anymore, at least in those bonds.
Yeah,
Now,
I think you even kind of called the top after the 3-day parabolic move. It's like, if you chase that, your downside risk is exponentially higher than waiting for some kind of breakout or a really lower range.
Yeah. You took a massive haircut on your bond purchase if you bought it at a yield below 1%, and it's now almost 1.8.
Yeah.
So
about a 20-25% pullback in the prices.
Yep.
So interesting stuff. We can go ahead and wrap it up. Are there any other, I guess, key lessons that if you guys wanted to just convey anything to anybody out there? I know right now, at least for me, and maybe some of you guys watching or listening to this are just exhausted from the amount of info and trying to keep up with it all. I know I am. It's been like trying to drink through a fire hose and just make sense of a very chaotic situation.
Mm-hmm.
In my personal opinion, I'll just give mine and then pass it to you guys to wrap us up. Mine is just be very careful about the opinions that you're listening to. And I think you should entertain all opinions and look at all sides. But again, like we talked about last week, be an objective outside observer. Don't jump into a camp and say, yeah, the US dollar is going to shit and everything's going to reset, or the other side, which, oh no, we're all fine, right? Like the truth is usually somewhere in the middle, and just try to think, how do I make the best long-term decisions, right? And so just a couple of like bullet points that I really wanted to point out in today's show is look for the bigger, longer-term moves. Ignore short-term noise. If you do that, you're going to put yourself ahead of 80 or 90% of people right there. And the number one goal, I think, at least for me right now, is capital preservation. Don't do anything that's going to take you permanently out of the game. And ask questions, like ask really high quality questions like, what would I do if insert market, Bitcoin, stocks, bonds, whatever, fell by another 50 to 90%? How would I respond to that? Or how should I position my portfolio today with that in mind, right? And just think like a chess player. Look at all the possible moves. Don't land on one and put all your chips in that basket. Try to remove your ego, think more about the possibilities and the probabilities, and set yourself up for a no-lose situation, which no-lose doesn't mean you don't take drawdowns or have losing investments. No-lose means you don't get permanent capital loss where you get taken out of the game. So I'll leave it there. And pass it to you guys, and feel free to wrap us up.
I'm just going to kind of piggyback off of you, Chris. And something that I meant to mention earlier is the market always finds a way to find your max pain area.
Mm-hmm.
And then that's when you start to question and you start to freak out and panic sell everything. And then you're left later with those regrets. Just try to, piggybacking off of thinking about the possibilities and probabilities, I can't stress that enough. It's really truly an exercise that helps you get a grasp of A, where you stand emotionally and you kind of can get real with yourself. And B, these questions aren't hard. They're actually quite simple questions that can be very, very effective. So do that and just think about making moves and decisions that will leave you with no regrets later. I can't stress that enough.
Awesome. Trav.
Yeah, well, I think we've probably given enough advice about, market stuff and Nikki nails the mental side. But for me, I just like to say, I guess this is a time when we need optimism. This is a time when we need compassion. So I just encourage people to take a deep breath, spend some time with their loved ones, take some walks outside, try to get your mind out of the market, especially once the markets are closed for the day, like in the, stocks or bonds. And just be good to people and help anybody out there in need that you can, because we all need each other right now. That's what's going to get us through it. So I know that sounds kind of cliche, but
it's true. I mean, in a world where we put so much power and faith in governments, right? Like, I think it's times of crisis like 9/11 where we saw at least people in the States really come together and push all the political bullshit to the side. I think now it's even more important because there's a lot of people out there that are living paycheck to paycheck that are going to really be in a lot of trouble in the short term. And hopefully the government can help. But at the end of the day, we're all people. Even the government is made up of just people. So I would love to piggyback on that and say, just look for how you can help your neighbors in today's craziness.
Absolutely.
Love it.
Cool. All right, guys. Well, don't forget to subscribe to the podcast. If you haven't done that yet, go to wetalkmoney.com to submit a question. We're going to try to get back to a more regular kind of show format next week. This week, I just felt like we just needed to dive in and just really focus on the biggest issue at hand, which is the virus and how the markets are responding to that. Hopefully this gave you some perspective, a balanced kind of objective approach. Again, we don't like to approach this with any strong belief. We are casual outside observers and we look for opportunity and just want to help people approach the markets with the right mindset. So hope this is helpful. And Nikki and Travis, thanks for joining me, man. You guys make this show so much better than if it was just me. So
Ditto.
Awesome.
Love you guys.
Yeah, you guys too.
And we appreciate everybody who listens.
Yeah.
We do.
For sure.
All right. We'll see you guys later. Take care.
Take care, everybody.